We're gonna first go over the syllabus. I'm not gonna take too much time on it, but let's go over a few things on it. A lot of the stuff you can kind of see already. The textbook is an intermediate textbook. If you've taken accounting 406, it should be the same textbook. So if you've already taken 406, see if you can just log in, and it should hopefully that it will be able to continue with your if you've already purchased it. If not, you can get any form of it is fine for this class. So and you don't necessarily need the connect component of it. Learning objectives, you can kind of look it through that if you want. Okay, course requirements. The assignments are worth 20% of the grade. If I can highlight them. And the exams are worth 80%. I should put that the exams are, let me add something here. I'll tell you what I'm trying to write, and then you guys can fill it in. The exam it'll be given after every chapter. So for instance, we come down here. Our first chapter, it'll say is chapter 23. So there's going to be an exam on chapter 23. We probably won't get to it till week 3, but yeah. Okay, so every chapter will have an exam. And by the way, the reason for doing that is that exams, if generally people retain more if you have a lot of exams that are smaller. People retain more, and they also generally do better on it. So that's part of the reason for doing it, mostly for the retention, but also because people generally do better with it. Okay, submitting work. All assignments are submitted in Blackboard. And usually the assignments are due 1 week after they are assigned. And this is important here. Late work is accepted without penalty. All right, so let's highlight. Let's put that in yellow. Late work is accepted without penalty. However, your grade will show a 0 for missing work until it's turned in. So your grade to date is going to look bad until you get it turned in, because there's a 0 in for wherever that grade is. So yeah, so if you don't get something in on time, it's not a big deal, but just get it in when you can. And again, your grade's going to look bad until you do get it in. Okay, this is some stuff. Hopefully you won't need to drop from the class, but if you do, here's some dates and stuff to remember. We already talked about this, the grades. There's the good old grading scale that we all know and love. Course per week. Assignments and textbook problems will be set for each chapter. Exams will be emailed, and this is important. They're only emailed to students. And at this point, I'm going to hop into, nope, not that. Assignments and submittals of work. So in Blackboard, under assignments and submittal of work over here, and this kind of tells you kind of what's going to happen. The assignments will be included in the assignments tab below. They're also in your email. Textbook problems are at the end of each chapter. Only textbook problems assigned below need to be turned in. Exams are emailed to students. So you will not find exams in Blackboard. Each exam is going to be emailed to you, and you turn in the exam that you're emailed. All right. So don't look for your exams in Blackboard. They're not going to be there. They'll only be in the emails. The reason for that is people will have different versions of the exam. Some may have Form A, Form B. You get the idea. So that's why you turn in what was the exam that was emailed to you. Format for submittals. You can either complete the document, for instance, type your answers right into the Excel or Word or PDF file. You can scan the documents. If you print out the document, fill it in, scan it, or write on notebook paper. That's fine too. You can also take multiple pictures of the documents or of the work on notebook paper. I should I kind of wrote that funny, but anyway, the assignments are all unlimited submittals. So what that means is if you have a handout that's 10 pages long and you take 10 pictures, you can submit all 10 pictures. There's nothing wrong with doing that. And it'll easily take all 10 pictures. So yeah, so when you submit something, I'll take almost any form that you want to submit it in. Now, the thing that is not allowed are zip files and page files. These are both when they take a bunch of files and compress them into one file, and Blackboard does not like them. So if you're taking pictures, don't put them into a zip file and don't put them into or a page file. Just submit the pictures individually. Because again, it doesn't. Blackboard doesn't like these. Now down here, you'll see the assignment is chapter 22 handout. That's gonna be the first one. I think I got this wrong. I gotta fix something in the syllabus. But anyway, it's actually chapter 22. Did I get all these wrong? I think these are all off by one. I was positive I fixed that. Obviously, I did not. These are all off by one, I believe. Darn it. Huh. All right. Well, I will give it an update. Sure enough, it's all off. Oh, wait a minute. No, only the first part's off. This should say 22. Make this correction if you would. Not a complete mess up, but I do mess up. So this is so chapter 22, statement of cash flows. And this will be the first thing we start out with. The rest of these are not the first couple ones here are not too crazy, and then starting about halfway through, we get into the wacky stuff. But anyway, statement of cash flows, we're going to do that first. And I will get a corrected one sent out for that. Reason for doing the statement of cash flows first. It's easily the most important chapter in this course. It's one of the 4 required financial statements, and I can guarantee you, oh yeah, I got to talk about that too. I'll guarantee you that you're going to have it on the CPA exam. Yes, next week at this time, I will be in the hospital because I drive like crazy and I'll probably get in an accident. No, I'm actually having a hip surgery on next Tuesday, so we will not have class next Tuesday. And it depending on how far we get in the handout, I may put an assignment in for next class. Right, it depends on how far we get. If we don't get far enough, then we won't. But anyway, no, we will not meet next week. And next week I won't be around for the email or even my phone for a couple days. If you call my phone, you're going to get my son. So anyway, yeah, so I'm going for hip surgery next Tuesday. So anyway, we'll have next week off. After that, it should be fine. So yeah, so no class next week, and that's why that's in the syllabus like that. Yeah. So this here I'm having hip surgery. Now, after my hip surgery, my dance moves should really improve. So look forward to that. But anyway, yeah, so next class I will not be here. Oh, thank you. Yeah, I've actually not to share too much. I actually had my left hip. I'm gonna get my right hip done. I actually had my left hip done, and it was tremendous how much better I felt afterwards. So I'm really looking forward to the surgery. And I tried to get it done over break. I really wanted to get it done over, this last between the quarter break, but they couldn't get it in. So anyway, unfortunately, week 2 I'll be there. Okay, so any questions though on turning anything in or as far as what's required for the class? So only those things. Let me point out one more thing. Only those things that are in the assignments. I'm gonna shrink this up. Only what's in here is what's due. So if you go to assignments and work submittal, this is the only thing that is. These are the only things that are due. So if you're wondering what's due, this is it. And usually the handouts and that will all be there, with the lone exception being for exams. Exams will be emailed to you. Okay. Did I cover everything? Let's see, I messed up here. I think any damage here is done. Let's go to the next thing, and that is the handouts. Now, this one is a little bit unusual because I have 3 handouts. Usually there's 2. I'm going to use the Excel handout when I go through mine here, just because it's just easier. But usually the handouts will be in MS Word and PDF, and they have to be in both of those for the American Disabilities Act. So those will be given, they're identical, or they should be identical at least. And then sometimes I'll send out an Excel file too. And this is one of those cases I have Excel file just because when you're doing the financial statements, a lot of times it's just easier to do it in Excel. And also being accountants, that you guys will be using Excel quite extensively when you're when you leave the school and embark on your career. Okay, so statement of cash flows. There is one thing I should talk about before I get too far into it. What we're showing, I'm going to show you here is what we're going to concentrate on. This is the indirect method. So the indirect method for the statement of cash flows. Now you're probably asking yourself, is there a direct method? And there is, but it's sort of like this. I'll do it over here. I'll just talk about it. There's indirect method and the direct method. So there's you have two choices on doing the statement of cash flows. You normally you'd think, okay, the direct method must be better. Actually, more companies use the indirect method. Now, here's the weird thing. So if you use the direct method, you must also do what they call a reconciliation, which is basically the indirect method. So if you do the direct method, you must also do the indirect, or you can just do the indirect. That's the reason why a lot of companies will just put out one statement of cash flows. It'll be the indirect. They have a number of reasons for claiming to do this, but one of them is that it's less confusing to have two statements of cash flows that people say, well, which is which? But so the indirect method can be done by itself. If you do the direct method, you must also do the indirect. So when we study it, the indirect method must be done whether you do the direct method or the indirect. So that's why we spend a little more time on it, that it's required either way. The direct method is basically just doing an income statement and you change everything into cash values. It's not that I shouldn't say it's not difficult, but it's basically a statement, income statement, changing everything to cash. How much cash did you get in? How much cash did you pay out? That kind of thing. Okay, so we're going to look at the indirect method, and the indirect method has 3 sections. You guys may have already had this before. Operating cash flows, investing cash flows, and financing cash flows. And over on the right, I got kind of the general idea behind it. The operating cash flows has the income statement and current assets and current liabilities. So income statement and the current asset and liability. So these come off the balance sheet. Or excuse me, this comes off the income statement, and these come off the balance sheet. On the balance sheet, the investing section is only long-term assets. Then we hop over to the other side of the balance sheet, and it's long-term liabilities and equity accounts for the financing. All right, and coming up here, I'm going to talk a little bit about this, and we'll see more when we get there. And it's a little bit confusing. Why am I going over so much? All right, well, whatever. So one of the things is what increases and decreases cash flows, and this is for non-cash assets, things like accounts receivable, inventory, equipment, any asset that's not cash, buildings, property, blah blah blah. If they increase, cash flow must decrease. Now, if you think about it, if you buy a piece of equipment, okay, so your equipment increases, well, you're going to pay for that with cash. Your cash must decrease. So that's really all it's saying, is that it kind of goes in the opposite direction. So if you have more equipment, that must mean you have less cash. You must have bought it. And vice versa. If you sell a piece of equipment, if your equipment goes down, you must have more cash. So it goes kind of in the opposite direction. So for non-cash assets, and we are talking about assets, but just assets that aren't cash, they go in the opposite direction. The cash flow goes in the opposite direction. For liabilities and equity, they go in the same direction. For instance, if you borrow money from the bank, you'll say you borrow $10,000. You now have $10,000 of cash. Your cash will go up. Your liabilities will also go up. Now you owe $10,000 to the bank. So liabilities go up as liabilities go up, so does your cash. You borrow $10,000, you have the cash. You also have $10,000 more liabilities. How do those liabilities go down? You're going to pay them off. So when liabilities go down, your cash goes down. So they go hand in hand together. And the same thing is true with the equity section. If you sell stock, you get the cash, they get more in your equity section. If you buy back stock, your cash goes down and the equity section goes down. So they go, the liabilities and equity go with cash flow the same way. If they increase, your liabilities increase, your cash flow increases. They decrease, your cash flow decreases. Okay, so these are kind of just the basic rules of it. Okay, so let's jump in and actually do a couple of these. Okay, so here's our cash flow. And so what we're going to do now, this first one here is kind of, it's already in basically the format that we need to be in. And that is income statement stuff first, then current assets, and then current liabilities. So we're going to do this kind of, I think we'll do over here on the side. Okay, so net income. What will that do for our statement of cash flows? And you use this up here. Oops, hold on.
Add it.
Yep. So this will be a plus of 18,000. Depreciation expense.
Again, plus.
Good. And then you might say, well, why do we add depreciation expense? And yep, good. We had depreciation expense because there's no cash. If you buy a car for, let's say you buy a car for $20,000, and the next year, because it's a used car, maybe it's worth 18,000, right? So you went from 20,000 to 18,000. A car depreciated by $2,000. You didn't actually write a check for that. There's no cash involved. So depreciation doesn't have cash. Now, notice that when you calculated your net income, you subtracted out depreciation, even though it didn't have any cash. So we're adding it back in because even though you subtracted it to get your net income, there was no cash. So that's what I can say a bit. Okay, now these are the ones that get tricky. I'm gonna do something here. I'm gonna move this down. Oh, I don't know. Maybe okay. I'm not gonna. I'll copy this. This is all we need. All right. So accounts receivable increase. What kind of an account is accounts receivable?
Asset.
Yep, it's an asset. It increased. So what happened to our cash? Oops.
Reduces.
Yep, decreases. So this will be a negative. Okay, prepaid expenses. Prepaids are also assets. This time it decreased. So what happened to our cash?
Increases.
Yep. Yeah, so for assets, these are both assets. Let me write that in. So these are both assets. They go in the opposite direction. So if they increase, then they decrease. If they decrease, then they increase. All right, down here, these are liabilities. Let's make those, I don't know, blue. Now, liabilities, they go in the same direction. Okay, so accounts payable decreased. So what happened to our cash?
Decreased.
Yep. Yeah, and you think about it, how does your accounts payable go down? You pay them. And same thing for this one, accrued expenses decreased. Okay, so this all together yep. I'm sorry, this all together. This will be our oops, that's not how you spell operating. So our net operating cash flows will be this. And by the way, it's fairly common to have net operating cash flows be higher than the net income because of the depreciation. So it's very common to have cash flows that are higher than the income. And sometimes you can even have income that's a loss and positive cash flows. Okay, see if you can figure this one out down here. Now they're kind of jumbled up. We do have a new one here. Gain on sale of equipment. What do we do with a gain? A gain will actually be subtracted, and you might question why. Why do we subtract gains? Well, you subtract gains because, oops, gains and losses comes from sales of long-term assets, investing cash flows. So we basically take it out of the operating to put it into the investing cash flows. So that's why gains get added back. Excuse me, gains get subtracted and losses get added back. Okay. I'm gonna do something here. Sets. Oops. sure I get this right. So decrease, so these are assets, they go in the opposite direction. And liabilities go in the same direction. So increase, increase. So opposite. Okay. All right. So I think I'm gonna check my answer on this one. That you got 14,130.
That's what I got.
Yeah, okay. Now notice something here. Notice that the second problem, they had more income, but their cash flow was less. And that's one reason why this statement of cash flow is it's come to be a really important statement. It's a really sort of important statement because a lot of times, part of the reason why they really wanted it is that the income statement didn't always tell the whole story. And you can see here the operating cash flows are actually less, even though they had more income. Oddly, the statement of cash flows is relatively new, is about 50 years old. A little less than that, but like 40 years old. But the other financial statements, the income statement, excuse me, statement of exchange earnings or equity, and the balance sheet, those are 500 years old. So it's fairly new, 40 years. You'll still find people that don't like it because it wasn't one of the financial statements when they were going through accounting. But it's actually a very kind of important one. Okay. I don't know why I got these separated. So, oh, I know why, because I added that column. I'm taking it out. All right. So coming down here. Now it's the same thing that we just did. But we got a couple additional things we have to throw in here, and that is we have to determine for these two down here whether they increased or decreased, and then also what kind of accounts they are. So we can do the easy ones first, I guess. Okay, so net income's a plus, depreciation expense a plus, a loss is also a plus. I know that sounds weird, but if you actually go up here, losses get added back in. Why? Because they're going to go to a different section. They're going to go to the investing section. Okay, so this is what we have so far. Now, accounts receivable, what kind of an account?
Asset.
Asset. Good. So Now, did it increase or decrease?
Increase.
Increased.
Yeah, it went, yeah, so 2002 was 10,000, now it's 11,600, so it increased by 1,600. Accounts payable. Payables are abilities. And it
Also
also,
increased.
yep, good, okay. So let's bring these over here. Okay, accounts receivable is an asset that increased. What happened to the cash flow for assets?
Cash reduced, therefore we need to minus that.
Yeah, so cash is gonna go down by 1,600. And if you think about it, accounts receivable, this is really $1,600 in cash that we haven't collected. Compared to what we had last year. So this is $1,600 that we haven't collected, so there's no cash for that extra 1,600. So that's why it's a decrease. Okay, accounts payable went up by 1,200. So that's the liability. So what happened to the cash? You go down or up?
Up.
Up, good. Oops. Okay, so this will be our operating cash flow. So now notice that it is the change in the account is what we're really looking for these for the assets, the current assets and current liabilities. We're really looking for what the change is in them, and then we'll figure out whether they are pluses or minuses or not. Okay. Let's jump into the operating section then down here. This accrued taxes is a liability. Accrued just means owed, basically. All right. Amortization expense is what happens to intangible assets. It's very similar to depreciation. Can also be or sometimes well, mostly intangible stuff. Gain is subtracted because it's going to go on a different section. It's going to go on the investing section. You know, I should probably put change. Descriptive. Okay, cash flow for accounts receivable. Plus or minus? Oops.
Minus.
Minus.
Yep. Inventory?
Plus.
Yep. Yeah, and if you think about it, inventory went down, that means you must have sold the inventory, right? So when you sold more inventory, your cash goes up. Liabilities, they go in the same direction. So if your liabilities went down by 500, you must have paid $500 in liabilities. If your accrued taxes went up, that means you must owe $3,000 more that you haven't paid yet, so your cash goes up. Ah, that's not right. Okay. By the way, just so you guys know, we'll take a break like around 7. I don't know, 10-minute break somewhere in there. Okay, I'm gonna save this so I don't. No. All right. So that's the operating section, and that's the hardest section, the most difficult section. I think anyways, and especially because you got to keep track of all these, the changes in the accounts. Question on that? All right. Let's go to the investing section. And the investing section is basically what happens mostly for long-term assets and buying and selling long-term assets. Now, the terminology is that a lot of times you'll see purchasing assets, a lot of times you'll say acquired assets, same thing. Sale of assets, a lot of times you'll see it called disposal of assets, same thing. So, the terminology can be a little bit funny sometimes, but anyway, acquired basically means buy, and sold or disposed of means to sell it. All right, so let's go through each of these. There's usually a lot less in this category than on some of the other ones. Not always though. Okay, acquired plant assets for 58,000. So what would happen to our cash?
Cash reduces, which
Yep.
is important, is it?
Exactly, yeah, because we were going to. Uh-oh. We have to format the cells in this one. Okay, so we bought assets, so assets go in the opposite direction. Okay, sold land with a book value of $10,000 for a $2,000 gain. So the question is, how much cash did we get?
12,400.
Yeah. So if we had a book value of 10,000 and we got a $2,400 gain, add those two together, and so that would be 12,000. Plus or minus?
Plus.
Plus. Good. Oops. This one is not applicable, and I'll tell you why. Trading investments are current. They're current assets. Which means that they should go on the operating section, not in the investing section. Investing section is for long term, whereas these are current, so this will be not applicable, I guess. Wrong section. Okay, now available for sale, those are generally longer term ones, so those can be those are in this section usually, anyways. How much should we get for these?
16,100.
Yep. So we got 6,100. Now notice this, you look at this loss and you may be tempted to put it as a negative, but the actual cash coming in is 16,100. So even though, oops, a little too much. So even though it's a loss, the cash flow is still positive from it. It may not be as much as we wanted it to be, but the cash flow is positive. Now, so this will be the okay, now here's kind of the strange thing about the investing section. Oh, wait. First of all, let's put the right label on here. Hold on. Net investing cash flows. Here's the thing about the investing. It might sound a little bit weird, is that for the investing cash flows, you want those to be negative, which kind of counterintuitive, but what that means is that they're investing in the company. They're buying more equipment, they're buying more long-term assets, they're buying more property or whatever it is. So a company that's staying the same size or growing is going to have a negative cash flow in the investing section. So as long as a company is growing, that will be negative. And you think about, let's say Walmart, they open up a new store. Okay, they gotta buy the land, they gotta buy the building, all the shelving and all that kind of stuff that goes in the store, that costs money. So you actually, for a company, generally speaking, you want it to be negative for the investing section. So while this might look bad, this is actually what you're kind of looking for. Okay. Down here, number 6. Purchased I guess I'm gonna come out a little further here. Purchased equipment for 9,000. So what happened to our cash? Go up or down?
Went down.
Down. Sold equipment that cost $5,000 and had accumulated depreciation of 3,300, and we sold it for $2,200 cash. What do we do with that one?
That would be a gain, right?
Well, it's not going to be, well, it actually, yeah, it would have been a gain, but keep in mind though, this is a statement of cash flows. So what will the cash be?
2,200.
Yep, yeah, 2,200.
Okay.
So yeah, you're right though, it would be a gain. This would have been a gain of what, 17, it'd be like 500.
Okay.
Yeah, it definitely would be. Okay, now tricky one. We sold a building, had accumulated depreciation of 14,000, and that gave us a $3,000 loss. So how much cash did they get?
18,000.
Yep. Yeah, so they're building for what was it? 35,000. It had accumulated appreciation of 14,000. So it had a carry value of 21,000. Had a loss. $3,000. So we must have cash of $18,000. So this would have been positive 18,000. Purchased investments.
So it'd be-
Negative.
Yeah. Okay, now this is kind of what you don't want to see. This is positive cash flow. And well, it means the company is shrinking, and you can tell that kind of here. They're selling off equipment, they're selling off a building. So they're kind of selling off things. It looks like they took the money and reinvested it, some of it anyways. So if it's positive, generally it could be, they probably have a good valid reason for doing it. I'm not saying that they don't have a valid reason, but a lot of times if they're shrinking, this is what it looks like. Okay, tell you what, let's take a break. What time is it? 6:57. All right, let's say be back at 7:08. How about? Okay, we'll come back at 7:08, and then we'll kind of finish. Hopefully we'll finish at least financing section, and maybe we'll get to this. We'll get this one done. Hopefully we will. Okay, so we come back at the 7:08. Hey. Oh, hold on a second. Green thing here yet. Oh, little setup here got moved or something. Yeah, close enough. Okay, let's go to. So just kind of let you guys know, we're doing the three different, here's operating, here's investing, here's financing, doing those separately. And then we're gonna put one all together. Oh, there's one more thing I gotta tell you guys, and that is that all these meetings are recorded. And they'll be recorded and they'll be put in the recorded Zoom meeting folder, which is empty right now. Oops, let me see here. Which is empty right now because this is the first class. But all of them will be recorded. So if you do have to miss a class or something like that, or if you just, whatever, something happens, you didn't catch part of it, they will be there posted. And I usually post those within usually within a few hours, but I have certainly within 24 hours they'll be posted. Okay, financing section. Long-term liabilities and the equity section. So long-term liabilities and the equity section. And also dividends. Dividends basically come out of retained earnings. Actually, there is something I got to tell you about this section here. And this is back on the overview. So in the equity section, you're going to have an account called retained earnings. However, the changes in retained earnings are due to net income, which are in the operating section, and dividends. So because of that, because those changes are already being taken care of somebody else, you ignore the retained earnings part of the finances of the equity section, because both the dividends and the income are on or will already be taken care of. Okay, so let's go through each of these and see what happens. Payment of dividends. Plus or minus?
Minus.
Minus. And I did not format these. So this is a new handout, by the way, in case you guys are wondering why it's so lousy. I decided to make a new handout. Proceeds from the sale of treasury stock. Plus or minus?
Plus.
Plus.
Yep. Issuance of common stock. Now, issuance is the same thing as saying sale of treasury stock. Oh, excuse me, sale of common stock. Oh.
So it's the increase.
Yep. And this is the strange one. If you have things like notes payable, especially, it could also be short-term loans and things like that. Things that aren't specific for things that aren't like accounts payable for buying merchandise or something you own to a vendor, but like say you go to a bank and you get a short-term borrowing. Even though this is generally for long-term liabilities, short-term borrowings also go in the financing section. So you'd say, okay, wait, that's a current liability, and it is. It's 90 days. It's current liability. However, because it's for financing and it's not an accounts payable say, it will go in the financing section. So we issued a notes payable, so we gave them the note and they gave us cash, so this will be plus. And so this will be our financing cash flows. And usually that is a positive. So usually the financing cash flows, you want those to be positive. And the investing one is negative. And those two a lot of times will go hand in hand. You do long-term borrowings and sell stock and stuff like that to get long-term assets. In finance, they call it the hedging principle. All right. I'm trying to think why I did the spacing like I did here, but anyway. Okay, issuance of bond payable. Issuance again is the same thing as a sale of bonds payable. So will that be a plus or minus?
Plus.
Plus. Good. Retired bonds payable. So you have these bonds you owed people and you retired them. What's the only way you're going to retire a bonds payable?
Buy it back,
Yeah, so your cash is going to go.
decrease.
Yep. Repayment of short-term loan. Okay, if this is a short-term loan and not like an accounts payable, but an actual loan. And usually if you pay interest on it, usually it goes in the financing section as a good rule of thumb. Okay, so repayment of the loan, plus or minus?
Minus.
Minus. And purchase of treasury stock. Plus or minus?
Minus.
Minus. Let me copy this and see what happens. Ooh, that's not right. And this is what you kind of don't want to see. You don't want to see that as negative. Usually it's when the company is shrinking. When they're selling their assets or something like that, that they will then pay off liabilities, pay off, purchase their stock, buy back their stock, shrink the company. I shouldn't say it's bad. It's just it shows that the company is shrinking.
Mr. Taylor, I got disconnected for a moment. So you were saying that you will want that to be positive?
Yeah. Generally speaking, you want the investing section and the financing section kind of go together. One's long-term assets, the other one's long-term financing. So there's a thing called the hedging principle in finance where you kind of want to match those up. So you get long-term assets, you use long-term financing. And generally, if a company's growing, their assets will be going up and their financing will also be going up. For no other reason than the balance sheet has to balance.
Okay.
Side goes up, the other side does. So the negative of how much cash you have to pay out for your assets, well, it has to come from someplace, and usually the best place to find that money is by long-term debt or selling stock.
Yeah.
Question on that? Okay. And now we're gonna put the whole thing together. Let's take a look here. So here's our income statement. And dividends paid are here. This is our balance sheet down here. And so we're going to use this to, oh, here's additional information. We need that. Okay. So let's go to our income statement accounts. We need our net income. I'm going to zoom in a little bit. So we got our net income so far. What else do we need off of here?
Depreciation and loss.
Yep and yep. Okay, so depreciation expense. Now remember, and actually you can kind of see it here. $345 was subtracted out, but there was no cash involved. So this 1260 doesn't have, is reduced by 345, even though there wasn't any cash here. So we're going to add it back in. 345. And the loss, the loss we're going to put in a different section. And losses are kind of like opposite day. And that we reverse those out because it's going to go in a different section. It's going to go in the actual investing section, which we'll get to next. Okay, current assets. Now, when we talk about current assets, we're really talking about changes in current assets other than cash. So these are going to be the current assets. Write that out completely. Okay, and we have to find the change in those two. So accounts receivable went from 3450 up to 4500. So the change is something wrong here. $1,050. And we'll do the same thing here. Change is 600. Okay, so let's see what those are going to look like. So accounts receivable, the change was 1,050, and this is a increase. So what happened to the cash flow?
Negative.
Negative. Good. You know, you can think about the 1,050 we did not collect. All right, and this was a decrease. Oops. Oh, 600. So inventory went down by 600. So plus or minus?
Plus.
Plus. Good. Yep. And again, we must have sold $600 of inventory. So if we sold $600 inventory, our cash must have gone up. All right. The accounts payable, the bonds payable is probably long term. So this is bonds payable. This would be a current liability. Oops. Okay, so accounts payable, and it had a change of negative $525. So is the cash gonna be going up or down?
Down.
Down, good. You know, how your liabilities go down, you paid them. So they must have paid 525. Okay, investing cash flow. Now this is a little bit tricky. And we're going to go down to this additional information down here. So long-term investments were sold for 405 and fixed assets were purchased for 3,000. Okay, so we're going to take both of those. Investments were sold for 305. Fixed assets were purchased for 3,000. Okay, so 405 plus or minus.
Plus.
Fixed assets purchased 3,000 plus or minus.
Minus.
Good. And so this is the net investing cash flows. And it's negative, but that's okay. That's what we want to see actually for that section. Let me get rid of those. They're bugging me. Okay. Now here's the weird thing. If you look up here, it shows the long-term investments had a change of $450, and yet it's only 405. Why? You know, why is this? The account went down by 450, but we're only showing cash of
There's a loss of 45.
Yep, right here. Very good. They did lose the 450 of what they had for their value of these long-term investments on the books, but they sold them for a loss, so they only got $405 from it because they lost 45 of them. Okay, let's take the other weird one. Fixed assets. We just bought $3,000 worth of fixed assets. But it only shows it increasing by 2,655. Why?
Depreciation.
Yep, very good. Very good. Yeah, it did increase by 3,000, but then we had this depreciation. So these are net, there's a net of depreciation. So this is, it went up to 12,000, but then we said depreciated $345 of it. That's why there's that difference between those two. Okay. Oops, where are we at? Changes in long-term liabilities. Okay, here's long-term liabilities. With the color of green, how about? Okay, so bonds payable. Bonds payable increased, so what happened to our cash?
Increase.
Good, liabilities go up. Okay, now common stock, you'll notice that didn't change, so it's gonna look kind of silly, but there was no change there. If there was a change, we would do something with it, but there's no change here. Common stock's the same. And retained earnings, we ignore that because the income and dividends are taken care of in other sections. There's one more thing we need. What do we need in the equity section? Here.
Dividends.
Yep. Oh, I got a separate line for it. What am I doing? Just doing crazy things up here. Okay, so this is dividends. Paid out 360. Okay, so here's what we're gonna do. Sorry for my yawning. I'm boring myself. We are going to add up the operating cash flows, the investing cash flows, and the financing cash flows. We're going to add all those together. I think I might just bring them down so we can kind of see them. And that's going to go into our net cash flows. So all three of these together will be our net cash flows. Now, here's what so we're gonna look at our beginning cash balance up here. So go to our cash balance up here. And our beginning cash balance was 2,700. Plus the 450 positive cash flow is 3,150. So you'll notice these two numbers here will match up with the cash account. I wish I could have those closer. What idiot made this spreadsheet anyway? All right, so this is let's see, insert so basically, we just explained how the cash went from 2,700 up to 3,150. You know, through these cash, these different sections, these three different sections here. I don't know if that makes it more confusing or not, but anyway, yeah. So this net cash flows is for all three parts of the account of the statement of cash flows, and then this will give us our net cash flows for the period. And we take the beginning balance, you know, the December 31st, 2022 will become the January 1st, 2023. So that's the beginning balance, and then this is the ending. Question on that thing? Okay, number 10, the last one in this is surprisingly similar. Couple changes, but fairly similar. Keep an eye on this. There's a gain instead of a loss. And I think I'll give you guys check figures for these. So a check figure for this one would be 810. Net investing cash flows, the check figure is negative 3,000. And net cash flows for financing is 2,730. So I'll let you guys work on that on your own. And in 2 weeks, oops, hold on a second. We'll come back, we'll go over it in a couple weeks. We won't meet next week, but we'll meet the week after that. And I think the due date for this is not that. The due date is Friday the 3rd. So yeah, you got a little more than 2 weeks to turn in. Okay, so I'll let you guys do this one on your own. And if you get stuck, don't be too proud to come back here and take a look at what we did on that one.
Professor, so if we go back into this spreadsheet, the pages that we did together here would be there with the numbers in it, or no?
Well, if you put the numbers in yourself, yeah.
Okay,
Yeah, and by the way, if you didn't miss a part of this, because I know that we're having internet connection problems. Actually, I think it's more not YouTube, Zoom problems.
okay.
I've
I
had
don't know.
problems.
It kept telling me I was not connected to the internet. And I'm like, why keep going out? But that's
I-
fine. I was taking notes along the way. I was just wondering.
Yeah, and it's, the reason I say that is because even from my computer, which I use for Zoom all the time, every now and then I just won't be able to get in, you know, and everybody else is getting in, but it's just a weird thing. Yeah, so you're gonna fill all these in. So the same thing we have here, you know, the all this, and then you turn this in and submit it in here, and yeah. So and again, it's not due for 2 weeks, so you have plenty of time to do it. And again, we are not meeting next week.
Okay.
Any questions? I'm glad, you know, I thought that we were gonna go along on this one. I'm glad we did. All right. Well, I will see you guys in 2 weeks' time. You may not recognize me because of my new hip, but you know, I'll see you guys on week 3. Any questions? Okay.
Questions? See ya. Thank you.
Thanks. Have a good
Thank you.
week.
Take care. Bye.
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 Thanks, Professor.
Thanks.
Have a good evening.
Thanks.